Hello everyone, welcome back to the Mind Your Growth channel, and we're going to be talking today about how to maximize risk reward and how to make sure that you are maximizing the most out of your trades. If you didn't find me originally from TikTok, I trade live on TikTok and here on YouTube every day at 11 a.m. Eastern Standard Time. I have tons of short form content on my TikTok page at Mind Your Growth, here to help you become profitable faster and independently. Subscribe here, I would really appreciate it. Follow along there. I promise you there's going to be content in there that you don't see anywhere else. I do not gatekeep. All right, here are the 4 things that I absolutely needed to be profitable and how I skewed risk reward in my favor. The first thing that I want to talk about is technical analysis and how you can use it to your advantage when it comes to risk reward. If you're not new to trading, you know that technical analysis is the ability to read charts, chart patterns, and candles. Now, it's not required to be an absolute expert and know every single chart pattern or candle structure that there is. I really only will use about 4 or 5 of these, and really the basics are what's most important here. I can sum this up really quickly for you. With candles, the bigger the body in a direction, as an example, this candle went up, the bigger the body, the more bullish it is. Or on the contrary, on the move down, the bigger the body of the candle, the more bearish it is. On the opposite side of that, the bigger the candles to either side will signify weakness to either side. Those basics will go really far, and I use those every day. I probably only know 4 different names of candle structures, and I trade profitably. As an example for the wicks, you can see a long wick to the downside here. That signifies weakness to the downside, which on its inverse would signify strength to the upside. Vice versa, long wick to the upside signifies weakness to the upside, or on its inverse, strength to the downside. With both of these examples, you can see that price action moved to the opposite of where those long wicks were. As far as candle structures, one of the most important ones that I use because I reversal trade occasionally is a doji candle. Here is what a doji candle will look like with long wicks and short bodies, long wick to the upside, long wick to the downside, and a short, small body in the middle. This can signify that there is indecision within the candle. Buyers push this candle up, sellers push this candle down. It wasn't sustained, and so the body closed in the middle. And the other candle that I use often is a hammer or an inverse hammer. In this case, this is a regular hammer with a very long wick to the downside, little to no wick to the upside, and a small body. Shows strength to the upside in the market because of that. Again, long wick down, it's going to push it up. Here we have an example of an inverse hammer with a long wick to the upside, small body. Will usually show that there's going to be weakness. As you can see, price action then pushed down after that candle. Now, it's important to be able to read some of this price action and understand it, but primarily at key levels. Utilizing this at key levels has helped me enormously. And so as you see some of these candle formations form at a key level of interest, note that that is often how you'll know to get in or to get out of a position. As you're in a trade, you can also continue to watch the formation of that candle structure to help you determine how long you should be in that trade or not. If you're in a trade and candles continue to close in your favor, stay in the trade. There's no reason to hop out. And when it happens that the candles are starting to go against your position, you know to either decrease your size or take the position off earlier than you would have normally, and thus decreasing your risk. The second thing that really helped me maximize on risk reward was taking trims of my positions or just taking a small piece of that position off as the trade goes in my favor. This allows me to do 2 things. The first is I secure profits from the get-go. And if you're still working on your psychology, it really helped me to see how long I could be holding my positions. The second piece was once you've secured those profits, you can then move your stop loss to break even and watch how long your typical setup will run. So you can let a smaller piece of your position continue to run maybe further than you would have if you had held that whole entire position. I took this trade at the beginning of this week to the short side, and the way that I played this was I got in here on this candle And as I saw this push down into key levels of interest, like the 9 EMA and the top of this supply, I trimmed half of my position. I then let it continue to ride to a 3R trade or to a 4R trade. And as I get multiples of that, I continue to take trims. As you do this again and again, you'll see which setups can run further than others. And then those ones that can run further, you'll just continue to hold those longer in the future, thus maximizing your reward. Third one is going to be really simple, but it's really hard for most people to implement, and that's just to respect your stop loss, or to at least have a stop loss from the very beginning of the trade and then respect it. If you don't have a stop loss from the beginning of your trades, I highly recommend that you do that. I don't think you can be profitable without that. Then once you're in the trade, and if it starts to go against you, your number one rule has to be to cut that, because if you don't, you're going to often be skewing risk to be more than your reward. So long term, as you take those trades and your risk is greater, even if you're winning 50% of those trades, but you're risking more than you should on those, you will not have a profitable system. The fourth is to learn the basics of volume. I highly recommend reading the book Volume Price Analysis by Anna Cooling. It's one of my favorite trading books, and I use its concepts every single day. In short, you don't need any complicated volume indicator if you just want to read standard volume. As you can see on the bottom of my screen, this is the standard indicator that comes with TradingView. I've just changed the colors to match my candles. You will want volume to increase in the price. You will want volume to increase in the direction of your trade. Or if you're playing a reversal, you ideally want decreasing volume as you approach that reversal area. As an example, this was a quick scalp that we took earlier this week. We have a long hammer here, and look at the volume down below. We had an increase of volume at a key level of interest. This was demand. I played this for a scalp to the top of this demand here because of this increase of volume. As we approached it, you could see that we had smaller volume comparative to the buying volume right before it. You always look at volume relative to the candles close by. Because there was decreasing volume as we approached this area, and then an increase of volume in the direction that I was looking to the upside, I got into that trade. You can even see this continue to play out on this retest as we then moved down right after with decreasing volume, less validity. We continue to push up beyond where we were before with higher volume in the direction that we wanted on that move. Let me know if these quick tips were helpful for you. I want to see you maximize risk reward because it's the only way to profitability, and we'll see you on the next video.